maybe. Hopefully we're going to sort of wake you up a bit now. We're hoping to have a bit of a sort of practical and interactive session. We did actually have the idea that you would use your calculators and do some workings out, but that didn't seem to work very well. No one seemed to be too keen to do that in the last session. So we might just kind of talk through or get people to give us their opinions, but we really kind of want it to be interactive. The idea sort of the session is to consider the setup and structure of a global program, a global property insurance program, and the potential implications that can arise from the different elements of cover that you could have in that structure. So we've sort of got sort of 4 activities or 4 things to think about. Just introducing ourselves. For those who don't know me, I'm Karen. I've been with FiscalReps in this role for a year, looking after the captive practice, but for 2 or 3 years on a consultancy basis. My background is insurance, and I've worked with major insurers and captives and global programs for most of my career. And I'll let Praveen introduce himself.
Hi, I'm Praveen Sharma. I head up the insurance regulatory and tax consulting practice in Marsh. Been doing this for 5.5 years. Previously to that, I was really a chartered accountant working for KPMG, dealing with the corporate tax affairs of London market insurers. So really, I'm not an underwriter or a broker, so you can challenge me to death on these issues.
Okay, so we've chosen a global property damage and business interruption programme for a UK-based parent company and a UK insurer for simplicity. We've picked some territories that we kind of think, you know, you could look at different options of how you cover them. So things that would challenge a broker, a risk manager and an underwriter in putting together that programme. So we have particularly picked those territories, and we've looked at the actual location of risk as well to make it a little bit more tricky, and we've provided some sum insureds. So you actually have this within your pack, so you might want to refer to this page within your breakout session pack, so that you can look at that in line with the first activity. So basically what we wanted everyone to do is to give us some input into how they thought they would consider doing a premium allocation methodology for this risk or this programme, and then how to calculate the premiums on a territory basis. So we've got a policy limit of 1.5 billion, a 1 million per occurrence deductible, and a net premium of 15 million. And I don't know whether, to start with, there's any information you think we haven't given you that you might need to consider for a premium allocation. I don't know if we have any underwriters in the room. I suppose whether we have underwriters or not will make a difference to the responses.
How many underwriters? None?
None.
Oh my God, we had all the underwriters in the previous session. Okay, so we got brokers, yes. But hang on, you're an underwriter. Rhonda is working for Excel, so she in tax, yeah. But what I meant by underwriter is an insurance company. How many insurance companies? 1, 2. Now, there we go. That's the right question.
Oh, hiding.
Yes. So we got a few. So on the premium allocation methodology for property risk, let's have an interactive session where we share knowledge and information. Would you agree that when an underwriter prices the risk, they look at various factors, not just sums insured? Say yes or no. You'll say yes, right? You'll say.
Totally inexperienced on this, but I would say yes, they'd have to include other factors than just the sum insured fatality. So I'm an asset manager.
An asset manager is answering the underwriting question. That's embarrassing. Okay. Claims experience.
Obviously, that would be one of the main criteria. Insured values is one issue, but if there's a really bad claims experience in a jurisdiction, that will influence the price allocated to that location.
That's interesting. So when we come to do the allocation of the premium, so you come up with this composite premium, right, for the whole group. How would we then allocate the premium for premium tax purposes that the underwriter is responsible for collecting and remitting? What factors would you take into account then? Sorry, Rhonda? Is that the only?
But for this type of risk, if it's property damage, business interruption, I'd say property values mainly.
That's the minimum, isn't it? That's the base. But given that the underwriter has taken into account claims history, probably also you've taken into account the fact that the property is in the middle of the ocean as opposed to on the mountain, or in an earthquake zone or terrorism zone or whatever, right? Yeah. Yeah. So I would argue, and I've done this many times, that we should look at all of those factors as well. I call it underwriting principles. That we should be allocating premiums based on underwriting principles where possible, and if it's convenient and possible to achieve that. Would you agree? Why don't we allocate premiums on the same basis? Yeah? Say yes.
Blank faces.
Just to make sure you're not going to sleep. Right, okay.
Okay, so then we've picked from the countries we've picked. Again, if you've got access to the list in front of you, it's kind of which of those territories you would put into which of the following buckets. So whether you'd write on a freedom of services basis, a non-admitted basis, DIC-DIL on a non-admitted basis under the master, or whether you'd require a local policy. I don't know if anyone's got any. We're going to kind of go into the implications of what structure we come up with, but I don't know whether anyone's got any ideas initially as to what buckets you would put the territories into. That's probably not the best use of phrase.
So if you go back to the countries again. Yeah.
Oh, I was going to say a few basic ones for the freedom of services. Obviously, the EU ones. I mean, it's really only France and Spain there, I suppose. The UK, you're in UK, you can write direct. Russia, I don't know about Russia. No, I wouldn't have thought so.
Okay. All right. When you say, Kate, if I may extend that, when you say freedom of services, right, does that mean that I don't need a French local policy?
What are we doing again? Property damage?
Yeah, property damage, so you'd be...
Yes, you might do, might not. No? Oh.
No. I was just asking because I was just trying to clarify what does freedom of services mean, right? Really, because freedom of services is misunderstood. I mean, the freedom of services means that an insurer in the UK is able to provide services to an insured in another member state, right? So technically, yes, a UK insurer can provide the cover for the property located in France or Spain quite legally from the UK. The question is, from a practical perspective, and given the nuances of France or Spain, would you as an underwriter or insurance company still go along with that, or would you say, no, I need a local policy because French terms and conditions, you're nodding your head, so I'm going to come to you if I may, because I'm not a broker, underwriter.
I'm not a broker, I'm a captive manager. But we have had this issue in France and in Spain, and we know that we have to write local policies. Otherwise, we are running into trouble. With the amount allocated to the company and the premium, and then to have the IPT correctly calculated, but not only the IPT in Spain, this very strange fire brigade tax, etc.
Okay, and then.
We'd be different. Obviously, we would do it on freedom of services. In a lot of cases, the policies would be issued from our jurisdiction, which isn't the UK, and as a consequence, the local policies aren't required by our insureds.
Okay, that's interesting. Any other people have different views? I mean, I've come across both these views, all right? It all depends on the underwriter and the client as to what they want to do. It's both. It's a joint effort, really. Both are legal, right? It's just that some insurers would insist on a local policy to cover local conditions under local languages. I don't know what Excel would do, but you know. Sorry, under.
My understanding, based on 4 months in the job at Excel, qualification, is that we would just, we wouldn't write the risk under a local policy. It would just be done on a FOS, Europass.
And I think quite a lot of policyholders won't want to pay the additional cost for the paper to be issued in all the countries, so they would rather have
Yeah.
freedom of services.
Yeah.
Yeah.
Yeah,
So if it's as tax efficient, it's just whether it's efficient for non-tax purposes.
correct, correct, yes. Okay, so Europe done. In terms of then,
Russia.
let's cover Russia. Russia insurance law doesn't necessarily allow a local Russian insured to procure insurance from an overseas non-Russian insurer, right? So effectively, I need a local policy from a Russian insurer, right? A Russian licensed insurer. So I didn't mean a Russian insurer. I meant an insurer that is licensed in Russia, okay? So it could be ACE, it could be AIG, it could be Zurich, that has a licensed entity in the country, that issues a paper in the country under Russian terms and conditions. Colombia, Canada, Australia, Singapore. Any views? Any experiences from somebody else? Well, Colombia changed its legislation this year. So with effect from July of this year, you can cover Colombian risks on a non-admitted basis. So an insured in Colombia can procure insurance from a non-Colombian licensed insurer to cover the Colombian risk, as long as it's non-compulsory class of risk. So a property risk can be covered. But what about Canada, Australia, Singapore? Any other views on that one? What do you think? Do I need a local policy? Do I need a non-admitted policy, or what? Sorry, Canada?
I believe you can write on a non-admitted basis in Canada and Australia. Singapore, I'm not so sure.
My experience, caveat, we are accountants. You can write, technically, non-admitted in all of these 4 countries, right? The problem is, or the issue is, and then this is where the underwriter has really a problem. Who is going to adjust the loss? So non-admitted insurance does not mean that an overseas insurer can walk into my country and then sell insurance without a license. What it means is that the insured can go out of the country and procure insurance from an overseas insurer, okay? But the insurer still can't come into my country and do things in my country without a license. So if I buy non-admitted insurance in these countries, how is the loss going to be adjusted? Who is going to adjust the loss? If there was if ACE had issued a policy in the country, your local entity would have covered the risk, adjusted the losses, and then dealt with the claims and so on and so forth, and then there's a DIC/DIL. So you need to think about, yeah, non-admitted is permitted, and then yes, we got tax issues or whatever, but who is going to adjust the loss? Do you agree? Disagree? Please share your views. Okay? So on that basis, your diagram here, we can do UK, Euro, France, and Spain on a FOS basis. And then, Australia, Singapore, Colombia, we've discussed that we can do it on a non-admitted basis. But
Interesting, the last session, a few people thought you couldn't write Canada on a non-admitted basis.
no, yes, but there are tax implications.
Yes.
Yeah, there are severe, tax penalties. Yeah, you're right. Actually, the next slide, you've got the, yeah. So we got the freedom of services here, and then the premium for that would be allocated on a just and reasonable basis using relevant factors. I call it underwriting factors. And then in Russia, I would argue that, yes, you need a local policy to full limit, but if there is a condition that is not available in the country, you can cover it on a DIC/DIL basis under the UK master provided you don't recharge the premium for that to the Russian entity. Because the Russian entity can still be covered here under the master, but nobody should be penalized provided that nothing is done in Russia in respect of that portion of the risk. Do you understand what I'm saying? So the DIC-DIL bit, there's a gap in cover. If I was a risk manager of that company and I said to my board, I did not buy cover in Russia or DIC-DIL to cover that gap for compliance reasons, I'll get fired. Because my job as a risk manager is to protect the assets and people of the group. So how do I protect it? I protect it by buying a local policy for limits, but there is a condition that is just not available in country. So risk manager sitting in the UK, walk down to, the London market, go and buy my DIC-DIL policy, master policy, including Russia, right? Just in case that catastrophe, that tsunami occurs in Russia, that enables us to, at least as a group, get some money from the underwriter. Okay? So I'm protecting the assets and people. I cannot be penalized in Russia because I've not broken any laws in Russia. My Russian entity didn't come to the London market to buy a master policy here. The insurer did not go to my Russian entity and sell the insurance over there. So, you can only break a regulation of a country if you are doing things against the law in country, right? So I would argue that your master policy. Now, some insurers, and ACE is included, I don't know how many other, Excel has got one as well, they've got what we call the financial interest cover, basis of cover, foreign entity loss cover. Sorry, I'm remembering all these buzzwords there. Effectively meaning that the risk in Russia is not insured by the UK insurer. The entity in Russia has no right under the policy against the UK insurer, but the parent in the UK is covered for the financial loss as a result of the subsidiary in Russia suffering an uninsured loss. So that was a long sentence. I tried to break it down with commas. Okay? So effectively, it becomes a UK risk because it's a financial loss risk in the UK, and UK premium tax will be due. So that way, the UK insurer is at least making it clear that I am not conducting any business of insurance in Russia. And
can I defer these costs from my UK tax return? Are these costs deductible from my UK tax return?
caveat time. I'm not a tax advisor. Technically, in the UK, in order to claim income tax relief on any expense, it needs to be revenue in nature, and also it needs to be wholly and exclusively for the purposes of its business, not the Russian business. Right. Now, my business is to protect my assets and people of my subsidiaries and group, but my business is also, that expense is incurred to protect my financial loss that I could suffer because there would be a devaluation in the investment in the subsidiary. So I'm trying to protect that devaluation loss. So that expense is deductible in a long about fashion. Okay? Do you get that? Was that clear as mud? Say yes. Good. Basis of cover.
No. So my understanding is that Dick Deal isn't always written with a financial interest clause.
It all depends on the insurer.
So at Excel, I think we write Dick Deal on both bases, so with FI and without FI. So from a premium allocation standpoint, what would we do with Russia if we didn't have an FI clause?
Very good question, and I'm glad you raised this, and I hope I have time to answer this because I'd love to answer it. It's a very valid question. If I don't have financial interest cover clause in the master, I believe that I still need to allocate, and I'm using the English word carefully, all right, because underwriters and brokers and risk managers you misuse the word allocation and recharge as, you know, being the same. Allocation is on an Excel spreadsheet on my desktop, right? So I allocate the premium to Russia. Oh, flipping hell. Sorry. Sorry, I'll put this down. Go on. While she's doing that. So we do the allocation on an Excel spreadsheet to Russia. So the dig deal premium is allocated to Russia. If there is an exposure in Russia at that layer, fine. However, and I don't have to pay any premium taxes on that because there is no premium tax I can pay in Russia. No way am I going to go to the Russian tax authorities and say, by the way, you know, I've recovered your risk from a UK insurer, here's your tax. There is no tax in Russia anyway, but you get the point. There is no way. One client of mine said, Praveen, I'm going to go to talk to the Brazilian tax authorities and pay their 7.38%. I said, no way, I'll never see you again because you'll be thrown in jail or something for breaching insurance regulations. Anyway, so you allocate the premiums, but I say to clients, you should not recharge that amount that you've allocated to the Russian entity. Because by recharging the premiums to the Russian entity, the Russian entity could be now complicit because it's now paid consideration in this non-admitted program. So, but if you don't allocate it and you say, oh, we'll call it UK premium, then you're unnecessarily paying 6% premium tax. Why? Right? And it happens, unfortunately, in Germany all the time. German companies, if they're not allocating to Russia, they consider it as German premium and they pay German premium tax. And that German premium tax is 19%. And I've done exercises where I've saved a client 1.3 million euros of taxes because they were just paying German premium tax and nothing else. Because the insurer was in Germany, the parent company was in Germany, they were buying the policy in Germany, they thought they just had to pay German premium tax on the total amount. That wasn't the case. Do you get that? Does that answer your question? Okay. But if you did the financial interest cover, then yes, then it becomes UK risk because the location of risk is now in the UK because it's financial loss of the UK parent you're covering, and then UK premium tax applies. And then income tax relief applies. Yeah.
So moving on from our proposed solution for a global programme, we're then going to look at the implications of that from a premium and then a claim perspective. And I know we've kind of covered off some of those already in the conversation. So basically from the settlement of premium and at the time of invoicing and setting up the policy, you know, in which territories do we have to consider cash before cover, any tariffs, terrorism pools, indirect and parafiscal taxes and premium tax points. And obviously we've split that across the territories. Now the original thought was that you could maybe go through that, but we'll maybe just flash the answers up and see if anyone's got any particular comments on them. So with regards to the UK, we don't have to worry about tariffs. There is a terrorism pool. In this case, there'd be 6% IPT due, not the increased 20%. London Fire Brigade would apply because the risk is located in London, and that would apply to the inner boroughs of London. And the tax point is on a cash received basis, so the premium tax wouldn't need to be paid until the premium had been paid. With regards to France, although there isn't a tariff premium as such, there would be elements of tariff premiums applying to the CatNat and the Gariat. Premium tax is due, parafiscal charges due, tax point fairly straightforward, not going to go through all the winky dinks. And again in Spain, again, I think, did someone mention earlier the complexities in Spain, or was that in the earlier session? Actually, I might be mixing my two sessions up with regards to a premium perspective. And I think that the time frame pressure is about the consortio, where the premium for that has to be paid, the premium tax has to be paid at inception, which doesn't give an insurer very much time Well, they have to fund it prior to receipt of premium. And moving on to when we get outside of Russia and looking at where we're writing non-admitted, things maybe get a bit more complicated, although from a Russia perspective we understand there are no premium taxes. Obviously we're issuing a local admitted policy, so that would be dealt with in territory to any effect. Did you want to add anything about Russia, Praveen?
No. I mean, you know, basically you need a local policy. The local insurer charges the local premium, and whatever the taxes that might be due is built into the premium. So it's not an additional add-on to the premium if there was a tax. But I'm not aware of any taxes in Russia.
And we've already talked a little bit about the implications from a premium perspective of DIC premium.
Yeah.
There wouldn't be any DIL premium in Russia because the policy would be to the full limit.
Yeah.
Then we go into Colombia, which we know to be new, to be able to write on a non-admitted basis, or there is a tax that would apply of 16%. I have to say at this stage, not quite aware of what the premium tax point is in Colombia. I don't know if that's something you know.
It's basically payable within a certain time frame. I mean, the legislation changed this year, where the authorities are still trying to work through the machinations of how the taxes would be paid. But what I believe is that the 16% IVA or VAT is still due by the insured within a certain time frame.
I would imagine the tax point would be payment date if it's a self-assessed tax.
Yeah.
Actually.
I would argue that, yeah. I mean, the question is payment date of, is there a time frame within which you have to pay or whatever, yeah.
And then we talked about Canada, and we talked about the, you can write on a non-admitted basis, although it might not be of financial benefit to do that. And I suppose that maybe, would be up to someone to outweigh the cost of having a local policy or fronted policy versus writing direct and paying the tax. So we've got, we've actually picked Alberta as the location of risk in Canada for this example, which has got the hefty premium tax, a provincial tax of 50%, which actually increases to 75% if you don't pay it within 30 days. That's in addition to the FET of 10%. There are also fire brigade levies depending on the state, but I have to say I have not confirmed whether or not they apply in Alberta. Big ones there. Do you want to add anything on Canada?
I always say to clients, when clients come to me and ask me, Praveen, how can I not pay these taxes? And my simple answer is just don't buy insurance. That will solve your problem. If that tax is your problem, if it's your biggest problem. However, in Canada, if you cover the risk on a non-admitted basis, yes, Alberta is 50%, and then federal excise tax of 10%, 60% in effect, and the 75% is with penalties. The question is, do you want to do that? Or do you want to buy a local policy in Canada using a licensed insurer such that the FET of 10% will go down to 0, and then the licensed provincial tax goes down from 50 to 3%, right?
So you write local policy.
Surprisingly, some clients still wish to do that. The reason why they don't want to break up the global program, they don't want a local policy, it depends on the exposure they have in country. It happens particularly on liability policies and D&O policies. And I won't go into care now. But property policies, you're absolutely right. They have certain premises in country. They want to then reduce it. They need to insure it anyway, so might as well insure it locally, right? Under local conditions. But if they've got a 2-man and his dog operation with a hut in Alberta, then I've seen clients saying, you know what, I don't need a local policy. I don't mind paying 50, 60% more because it's still less than the fronting cost plus the broker costs and all that. Yeah. So you got to weigh up the options of these, various methods. Any observations on that? No. Okay.
So moving on to Australia, writing on a non-admitted basis, the implication would be additional tax of 3%, federal income tax in addition to the local stamp duty. There was fire brigade tax in Victoria until last year, which was then abolished. We've picked Victoria as the location of risk in this instance. But apparently it still applies in New South Wales, I'm told. With regards to Singapore, from a premium perspective, straightforward on a non-admitted basis, because the premium tax only at GST 7% only applies if you write a local admitted policy rather than if you write on a non-admitted basis.
Just on the non-admitted, yes, Canada, Colombia, Singapore, Australia, say we do cover it on a non-admitted basis. So the UK insurer, my bugbear with insurers is, where will you pay the claim? So you're covering the risk in these countries on a non-admitted basis. Where will you pay the claim? Will you pay it to the UK parent? Or will you pay it to my Australian entity that suffered the loss directly? Both have different income tax implications. You're nodding your head, so you agree, yeah? So I would like to know from underwriters, what is your view that if you are covering risk on a non-admitted basis, or even if there is a local policy, but there is still a DIC-DIL master policy covering risk in Australia on a non-admitted basis, and the loss arises at that level, where will you think the insurer will pay the claim? Well, I'll tell you, it varies from insurers to insurers. There's a huge amount of inconsistent answers I get, depending on which insurer I'm dealing with. And this inconsistency is driving our clients nuts, yeah, because technically, you know, they would want the claim to be paid in country where non-admitted is permitted, but some insurers have got internal corporate governance structures and procedures that they cannot override, and they will pay the claim to the UK parent. If the UK parent receives the money, the UK parent has a potential income tax cost at the income tax rate of 25%. But if the parent, if the subsidiary received the money in Australia, the loss in Australia would offset the receipt of claim so that the tax effect is zero. So that's an issue that we need to think about when we are structuring global programs.
I think we're talking about the implications on the premium side. I mean, generally they seem to be more onerous to the insurer, whereas on the claims side, potentially they're more onerous to the policyholder. I was saying to Praveen earlier, a couple of examples in my previous life of you know, where financial interest clauses have applied, and in both instances the insurer was compliant and comfortable that they'd done everything on the right basis. One was in Russia, and it was a property damage claim, and it was a business interruption claim caused by the government switching off the gas supply, which caused a business interruption claim for a business manufacturing. It wasn't covered under the local policy, but it was covered under the master. So it was seen as a DIC claim, which was excess of $1 million, which then led, you know, the insurer was fine, the insurer paid the claim to the parent company under the terms and conditions of the policy, and then the risk manager then had the issue of discussing with his tax manager why he had a $200,000 plus income tax bill for paying the money into Russia. The second instance was a DIL claim in Colombia on a crime program where the client had a captive that wrote a primary $750,000 policy on an admitted basis, had a local policy. Obviously this was before the Colombia rules changed, and the claim came in at $1.5 million, which meant there was a DIL exposure. Now, as luck would have it, in Colombia, if you, when you're caught of kind of, in those instances it went to court, you reduce your prison sentence by the amount of money you could pay back, which flukily brought the claim into within the policy limit, so there was no corporation tax. But obviously you don't want to rely on that as but again, in that instance, you know, the insurer had done everything right, the insurer felt that they were compliant. It was the policyholder that suffered the loss.
I mean, people, when they're arranging insurance programs, they get absolutely paranoid about premium taxes. I get calls from, you know, far-flung places like Middlesbrough, from the US or Los Angeles in the middle of the night saying, Praveen, how do we deal with UK premium tax of £2 or something? Literally, I'm not joking. And I'm saying, you hung up about premium taxes? Have you discussed with the insurers about the claim? Because the claim or the income tax could be substantially more. So, you know, these issues, the financial interest clause, a number of insurers now are using it. The question is, how robust is it? So you just can't accept any insurer's word for it. I would need a legal opinion on that wording. And at the moment, there are, in my personal view, 4 insurers who have got a reasonably robust wording. And, you know, and if anybody else has got a wording, I'm happy to look at it and give you my opinion on it. But it's this issue, corporation tax or income tax, that is a huge cost. And believe me, I mean, Karen has shared with you 2 examples. I can share with you hundreds of examples over the last 5.5 years I've been at Marsh, where companies have suffered significant amount of income tax, such that the total cost of risk has blown through the roof. And I'm still waiting for issues around Japan and the tsunami, because that is such an unusual event that I really would want, you know, Japanese authorities to come out with an edict that in this exception circumstance, a master insurer can pay the claim directly to the Japanese insured. But they haven't done so, and it's causing a bit of an issue in the market, especially on contingent BI, right? Because multinational companies working in Japan or operating in or from Japan, they've got sister subsidiaries operations that have a knock-on effect in Thailand, Indonesia, and Malaysia, and so on and so forth. That creates a contingent BI loss. So what happens to that? So, but I do believe that some insurers are taking a more pragmatic approach and said, in this exceptional circumstance, we will pay the claim directly to the Japanese entity, which is quite commendable, actually. So, I mean, I just wanted to share that, a few experiences of mine, and thank you, Karen, for sharing yours. I don't know whether anybody else wants to share their views, if it's more interesting. Any other comments or views about what we've said today?
Okay, I'll make it quick. Are you finding that many insurers are offering indemnities for the local companies, so where it's non-admitted, non-permitted? Are you finding that insurers are offering indemnities for corporation tax that the local entity will suffer?
I wish I would make this session a bit longer. What Rhonda is talking about is a tax indemnity and warranty clause in technically the master policy. On property policies, there is a standard wording that Marsh uses that is generally accepted in the market. And insurers do provide that tax warranty and indemnity clause on the property policies. The reason being that you've got the Manhattan skyline structure here, there, right? So you're buying full limit local policies. The only time it'll get triggered is, you know, if there's a DIC-DIL payment paid in the UK for a Russian loss, and the Russian entity suffers a tax loss, and then the tax loss credit is, say, 20%, but the income, the money is being paid to the UK parent, and the tax share is 25%, so the 5% delta is then grossed up, and the client gets a little bit more to compensate for the 5% delta under the tax warranty clause. That's what the tax warranty clause does. Yeah, so many insurers do provide it on the property policy. On the liability, it's depending on the program structure, whether it's a Manhattan skyline or whether it's a flat line structure, you know, €1 million local policy with 100 million master. So under the liability policy, if it's a flat line structure, then insurers are quite right not to offer that tax warranty clause, because why should I? It's going to always be triggered. But if I buy a Manhattan skyline liability policy, then yes, you may wish to consider it. Any disagreements with that? Or views? Does that answer your question? Yeah? Any other questions? Oh, on the bell. No more questions then. The bell's just rung up.
Thank you.